So I wanted to start out with just a few definitions of value. We hear a couple of different terms that are thrown around from time to time. We hear fair market value, we hear fair value, we hear intrinsic value or strategic value. The definition that we use most frequently in tax valuations specifically is fair market value, and that definition is the price at which property would change hands between a willing buyer and a willing seller, neither being under any compulsion to buy or sell, that is, there's not a forced sale, and both have reasonable knowledge of all relevant facts, right? So there's full information, there's time in which to transact, right? And the price at which that willing buyer and that willing seller would transact is what we call fair market value. And that comes to us from revenue recognition rulings and is used by the tax courts predominantly in the tax arena. Another definition that we hear frequently is fair value. Fair value we hear in two different arenas. One is in the financial reporting arena. So when we're doing a valuation and there's a valuation of an asset that's going to go on a company's balance sheet, for example, or valuing equity as compensation and it's going to impact the company's P&L, right? The standard of value there is fair value. We also hear, and I'm going to just kind of flip over, just sort of skip this, but the IRS Revenue Rulings 5960, again, this is where that definition of fair market value came from. And there's certain guidance in this particular revenue ruling on considerations that we as appraisers need to make when we're doing a valuation of a business or an ownership interest in a business. And you can see what some of these considerations are, but it guides us to look at book value, which we can talk about later, earnings capacity of the company, dividend paying capacity, and to look at the market for similar publicly traded companies. And so when we talk about the different approaches, so there's some reason why, we need to adhere to these different methodologies, or at least consider the different methodologies that we do. The other arena where we talk about or use the standard of value of fair value is here, and this is what probably many of you were familiar with, right? And so this is a legally created standard of value that applies to certain specific transactions, and it differs from jurisdiction to jurisdiction and state to state, right? So when we're doing the work that we do, we need to be very mindful of how that fair value is defined within the specific jurisdiction for which we're doing the work. Another definition or standard of value that we hear often is investment value, also referred to as strategic value. And this would be the value to a particular buyer, right? So it's not fair market value or it's not fair value, where we look to sort of this market participant concept when we talk about fair value. But investment value or strategic value is that value to a unique buyer, because there was something in either the combination of the two entities or something unique that would cause that particular buyer to pay more than, say, a typical market participant would be willing to do. So those are some different. So and Tom's going to talk about some other definitions or standards of value a little bit later in the presentation. But fair market value, fair value, those are the two that generally we're doing all of our work, most of our work. Sort of why valuations are needed is the next section that we have here. And I know when I tell people that I do business valuations, most of them will say, oh, for M&A. Right? And so, well, yeah, maybe. And that is one of the reasons why somebody comes to us to have a valuation, but generally not. Most of the work that we do, that I do anyway, is in compliance with either a financial reporting requirement, a tax reporting requirement or compliance, or dispute, right? So a little bit more detail on that. So the valuation work that we do, and again, when somebody comes to me for a valuation, and I think for the most part, Tom too, is they need a piece of paper from me, right? They need a report, they need a piece of paper from me that says, okay, it is my opinion, but the value of this business enterprise, or the value of this ownership interest, or the value of this asset is whatever it is, and then these are all the reasons why, right? So it's a piece of paper that they need, and it generally gets attached to a financial statement or a tax return, or it's used in court in a dispute. And so we talk about...
Yes. You didn't mention seeing there estate tax, estate purposes. Is that sort of
So I sort of,
Earlier, is that wrapped into one of the-
that's wrapped into my tax. When I'm talking about tax reporting, tax compliant, then yes, the state, so whether it's the death tax, the 706 return, or it's gifting transactions, that's a lot of the work that we do. In this home as well.
I see you have corporate finance. Do you get involved for companies that are going out and raising capital, especially for startups or venture stage companies where you're brought in, say, to justify a pre-money valuation?
Okay, I got to repeat the question, right? Yeah, so I guess the question is basically, do we get involved in performing valuations for capital raises, equity raises? Is there anything else? Is that the job?
Basically,
Yeah.
yeah.
Go ahead,
Yes,
Tom.
yes, we do. And in particular, in two ways. One, we will render fairness opinions, whether a transaction is fair from a financial point of view, because the board of directors in most states and under Delaware law certainly are under the business judgment rule. So if they don't have expertise in valuation, which they typically don't, they hire an independent firm like Marshall and Stevens or Sanli, Pastore and Hill. Secondly, if a transaction's heavily leveraged, you need a solvency opinion as to whether after the financing occurs, is the company solvent from a financial point of view. Following the bankruptcy code for the US and also the state of the incorporation of the acquired company.
Okay, but you wouldn't get involved if, say, I have a company, I'm looking to raise, I don't know, $5 million, and I'm saying that's 20% of the company. You don't come and provide a valuation of the company that says, yes, $5 million post-valuation will be 20% of the company.
Yes, so I guess the question is, if there's a $5 million capital raise and it represents, and they think it represents 20% of the company, will we do a valuation for that?
Yeah, and the answer for that is yes. So we would get involved in situations like that, where the business owner says, okay, so I need $5 million. How much of my company do I need to give away for that, right? So we may advise them on, well, we can kind of do this in stages, right? So you're giving away as little as possible up front, but sort of this is what we see as the pre-money valuation, right? So there's always a challenge because they're startups, right? And oftentimes they're pre-revenue or certainly pre-cash flow. And so a lot of it's pretty speculative, but we can help set some parameters around, right? We think, if this is what you need to bring in, right? This is sort of percentage of the equity of the business that you're going to have to consider giving away, right? And oftentimes we also get involved with valuations around financings where some of the equity is given then as key executives, right? Where equities, options, or stock grants are given to key executives or even to the investors, right? And so we'll do those valuations either as part of the financing round or just subsequent to.
Okay, and one last related question. Do you do 409A evaluations?
Well, so that's
The question is, do we do 409A valuations?
Yeah, and that's exactly what I'm talking about, right? Where we're valuing equity as compensation or equity that's given to investors. And sometimes that's as part of a financing round where we'll go through and we'll do a valuation and we'll look at the fundamental valuation approaches, which we'll talk about later, the market approach, income approach, and a cost approach if it's appropriate, which it probably isn't. But then we'll also look at that financing round, right? And we'll say, okay, well, what's the implied enterprise value off of this financing round? But then what are the different rights and privileges between the investor in this round and this, equity instrument that I'm valuing over here, right? And so to make appropriate discounts perhaps or looking at the different valuations for the different classes of equity. All right, so are we on tax reporting and compliance? So again, just as you talked about, so the state and gift tax, all sorts of reasons why for tax purposes, right? A business owner or shareholder would come to us for evaluation from charitable contribution of the property to C to S conversions, estate death tax, as we talked about, the 706, or gifting, or various different tax-related valuations. Finance reporting, again, this is where there's an asset that needs to be valued or a liability that needs to be valued that's going on the balance sheet of the company, or there's something that impacts the P&L. And generally that would be the equity as compensation that we would see on the P&L. And so we talk about purchase price allocations here, impairment studies, the 409A, fresh start accounting, those sorts of things.